If you're thinking about buying a home, understanding the basics about mortgages and how to get the right one is essential. Canadian mortgages can be a tricky maze, and missing out on this crucial information could cost you big time. And so what we're doing today is we're going to dive into the basics of Canadian mortgages, covering everything that you need to know to get you started on your home buying journey. Now, before we get started, if you're new to this channel, my name is Glen Hopkins, and I create videos all about Canadian real estate and my local market of Surrey and White Rock, BC. So if that's something you're interested in, please be sure to subscribe, hit that button, and that way you won't miss out on any of my upcoming videos. Also, if you'd like my help with either buying or selling a home here in Surrey or the White Rock area, there is a link in the description box below where you can schedule a call with me. And if you're anywhere else in Canada and you need a referral to a fantastic agent, don't worry, I've got you covered. I know amazing agents throughout the country that I will gladly connect you with. All right, let's get into it. So what is a mortgage anyway? Well, in its simplest form, a mortgage is money that you borrow to buy a property. So imagine you found your dream home for, say, $500,000, but you only have $100,000 saved up. Well, if you use that $100,000 as your down payment, you'd need a mortgage for the remaining $400,000. That's pretty simple, right? Now, if you're putting down less than 20%, you're going to need mortgage insurance. And in Canada, we have three main insurers: 𝗬𝗦𝗂𝗏, Sagen, and Canada Guarantee. And the good news about mortgage insurance is that because it helps reduce the lender's risk, it makes it possible for them to offer you a mortgage at lower rates, and even if you don't have a big down payment. I remember buying my first home and I felt overwhelmed trying to figure out how much I actually needed to save for the down payment. Should I be saving 20% or should I save 5%? Would that be enough? So let me give you a quick breakdown. For homes priced at $500,000 or less, the minimum down payment is 5%. Now, for homes between $500,000 and $999,000, it's 5% on the first $500,000 and 10% on the amount above $500,000. Well, for homes priced at $1 million or more, the minimum down payment is going to be 20%. So for example, on a $700,000 home, you'd need a $45,000 down payment, $25,000 on the first $500,000 and $20,000 on the remaining $200,000. Okay, so let's talk about rates. There are two types of rates. There's fixed or variable. Now, fixed rates stay the same throughout the mortgage term, giving you stability, but usually at a higher cost. Well, variable rates, they can fluctuate based on the Bank of Canada's key lending rate. And typically, variable rate mortgages, the rates are lower and they often save you money over time. However, there is a bit of risk because the rates can and sometimes do go up. By the way, if you're getting any value out of this video, please do me a favor, hit that like button. It only takes a second, but it really helps me get the word out to other people just like you who might benefit from this video. Okay, so the next thing you need to understand about mortgages is what's the amortization and terms. Amortization is the total length of time it takes to pay off your mortgage. It's usually up to 25 years for insured mortgages and 30 years for uninsured mortgages. Now, the term, on the other hand, is the length of time the mortgage rate is locked in. So you might have a 5-year term with a 25-year amortization. And when your term is up, you're going to need to renegotiate a new mortgage for a new term. Now, this is a great opportunity for you to shop around and see if another lender might be able to offer you a better rate and terms than your current lender. So with the help of a mortgage broker, which I'm going to tell you all about in a minute, be sure to take the time to shop around. By the way, just a fun side note, the word amortization comes from the Latin word mort, which literally means death. And that's because the loan is gradually paid off over a long period of time, almost like paying it off until death. All right, next up is your payments. And payments for your mortgage can be monthly, semi-monthly, bi-weekly, or weekly. And choosing to make accelerated payments can help pay off your mortgage faster and save you on interest. So as an example, by choosing to make bi-weekly payments, which is about half of your monthly payment, you'll end up making what's equal to one extra payment each year. So check this out. Let's say you have a $400,000 mortgage at 6% interest rate on a 5-year fixed term. If you pay monthly, you'd pay $2,560 each month. But if you switch to accelerated bi-weekly payments, you would pay around $1,280 every 2 weeks. Now this means you would make 26 payments a year instead of 12, which adds up to one extra monthly payment. And over the life of your mortgage, you could save as much as $40,000 to $50,000 in interest by doing it that way. Additionally, your mortgage might have the option to make yearly lump sum payments, which means you can pay an extra amount on top of your regular payments, directly reducing your principal. And so as you can see, this is why it's so important to look at the terms of the mortgage and not just the face value rate. Okay, so next up, we're diving into why pre-approval is crucial and the difference between using a broker versus a bank, and you're not going to want to miss that. So getting pre-approved is an absolute must, but beware, not all pre-approvals are created equal. Fully underwriting pre-approvals involve verifying job letters, pay stubs, and other documents, enabling lenders to give you a reliable number, while non-underwritten pre-approvals, on the other hand, are often just rough estimates. So why is having an underwritten pre-approval so important? Well, it's kind of like having a guarantee that you're actually going to get the mortgage you need when you find the perfect home. You see, if you only have a non-underwritten pre-approval, it means that the lender hasn't checked all of your documents thoroughly. And this could put you at risk of not actually getting the mortgage that you need when you need it most, right after you've made an offer on your home. I mean, imagine finding a dream home, making an offer, and then only discovering you can't get the mortgage you thought you were pre-approved for. It is not fun. Okay, let's talk about mortgage brokers versus banks. Now, straight up, mortgage brokers, they can usually offer you better deals than the banks can because they have access to a wide range of lenders and mortgage products. Now, what this means is that they can shop around for you to find the best mortgage that suits your specific needs. Plus, a mortgage broker, they usually have more knowledge and experience with different types of mortgages compared to bank specialists. However, this is not always the case, so it is important that you find a broker with a good track record. One great thing about using a mortgage broker is that their services are typically free. They get paid by the lender and not by you, which means you get expert advice without any extra cost. So my recommendation is to do your everyday banking at the bank, but consider a mortgage broker for your mortgage. And by the way, if you do need a reference for a few top-notch mortgage brokers, just let me know and I'd be happy to share those with you. And by the way, it's super important you understand what lenders are looking for so that you can actually get a mortgage when you need one. Now, lenders look for three main things when deciding to approve a mortgage: your credit score, your down payment, and your income. Plus, they also evaluate the property itself to ensure that it's a good investment. Understanding and preparing for this can be the difference between getting your mortgage approved or having it declined. So here are a few tips to help you get ready. Number one is credit score. Make sure your credit score is in good shape. Pay your bills on time, reduce your debt, and avoid applying for new credit cards or loans right before applying for a mortgage. Number two is your down payment. Save as much as you can for your down payment. The more you put down, the less risky it looks to your lenders, and you might also get a better interest rate. Number three is your income. Lenders want to see stable income. So ensure your employment situation is secure and avoid job hopping right before applying for a new mortgage. And four, avoid big purchases. Don't buy a new car or make any large purchases on your credit before you apply for a mortgage. This can affect your debt to income ratio and make lenders nervous. And you know, there's so much more about buying a home that you need to know about, including the right neighborhood, knowing the types of houses to avoid, understanding closing costs, and more. So make sure you go ahead and watch some of the other videos popping up right now so that you make the right decision when purchasing a home. And remember, go ahead, leave a comment below and share your thoughts and your experiences. And of course, if you have any questions, feel free to ask, and I'll see you on the next video.